Just one candle is all you need to learn to identify accumulation and your bias in which direction the market might move. Interesting, right? Don't forget to like this video and we begin. Today we talk about CRT. As you understand, all we need is just one large bullish candle or CRT candle. On which time frame should you look for it? Since the market is fractal, this will work on absolutely any time frame. But based on my experience, it works most often on higher time frames. And is there any point in going down only to the 1 hour time frame? Lower than that, the ranges become too small. Now, let's break down a bullish candle and see how it should form, and how this will later influence the price reaching the upper and lower zones of that candle. We'll also touch a bit on structure and why you're trading it wrong. First, let's analyze the euro-dollar pair. On the weekly time frame, we need to find this large bullish candle. It was quite big and also swept liquidity on the left side of the chart. But honestly, that's not even necessary because, as you understand, we'll be working within the range of this candle. We can easily push to take out this high and then drop to take out this low. And when we eventually target this candle's range, we might just grab the leftover liquidity sitting here on the left. So that's not a mandatory factor. We only need to find a large bullish candle. Next, we need to look at what's inside this big candle. This is a weekly time frame. Let's mark this as our potential future range. And then we'll break down the structure inside this candle. On a daily time frame, we can see an imbalance on the buying side here, and there is another imbalance over here as well. And by the way, you may notice that once again, we have a large bullish candle, we have a large bullish daily candle. The previous high was taken out, and now we'll likely head down to test this low. A small range is also forming here, but that's not directly related to our weekly analysis yet. At this point, we have essentially identified insufficiency, and now we can move to a lower time frame. Since we are near the high of this weekly candle, the most likely scenario is that we'll push to take out this high first. So the broader context is potentially bullish, but because this weekly candle was extremely strong, creating significant insufficiencies on the buy side, we'll likely see a correction toward the 0.5 zone. Therefore, for the current new week, this low will act as liquidity that we might target, sweeping it first before considering any long positions. This week we saw the price drop into this imbalance located around 0.5 zone or even below into the discount area. From this zone we could have considered long positions, as there is an imbalance here and a clear order block, a major one likely on the daily or even weekly time frame. Now let me briefly touch on structure. Traders who rely solely on structure as the primary factor for determining bias are no different from those trading support and resistance. Why? Because structure can be drawn in any way the market wants. Right now, we see a high, a low, another high, then another low, followed by another high. Logically, price could reach this order block, react there, and then continue lower, because the overall structure hasn't shifted yet. So what do most traders do in this scenario? They open short positions, placing their stop losses above this high, or that one, or even somewhere across this entire zone. But here is the problem. By doing so, they're essentially giving the market a clear liquidity target. Big players, no retail traders cluster stop loss there, so price will often spike into those levels, trigger the stops, and then reverse. That's why blindly trading structure without considering liquidity, imbalances, and higher time frames contexts is just as flawed as trading basic support and resistance. The market hunts predictability, but remember, market structure is formed purely by liquidity. Right now, you might think this should be the high, but the market can easily paint a fake high like this, making you believe the trend has broken. Structure can always be violated and trends can reverse unexpectedly. However, traders who truly understand how structure forms, and more importantly, how liquidity drives it, will see that price has already swept the liquidity from this high. That means we should actually be looking for short opportunities here. Yes, I agree, we're near a major high, but don't forget, we're inside a massive weekly range. And what does price do in the range? It accumulates longs and shorts. Earlier I mentioned that this is a short accumulation zone because there is a ton of liquidity sitting below, right here. We've already swept the major liquidity on the left side of the chart, so my expectation is that price will continue lower, grabbing liquidity from here and here. There is also a cluster of equal lows in this zone, a 4-hour imbalance, but these are just liquidity traps. So what actually happened? When everyone thought structure was breaking, where did they place their trades? They likely opened position below this liquidity, somewhere in the discount zone, hoping for a bounce. But in reality, that liquidity is exactly what price will target before continuing down to sweep the bigger pulls. So what did the chart ultimately show us? Price dropped all the way to this low, and those trading smart money concepts incorrectly or relying on support and resistance will be wiped out here. Understand this. In such ranges, price couldn't care less about your structure. It follows liquidity. And liquidity, as I've said before, is what truly matters. Within this range, inside this large bullish candle, price will form accumulation. And we can only trade this accumulation after price reaches a major liquidity pool, either this high or this low. Whichever side we reach first will likely hint at whether we'll break higher or lower. But again, since I've mentioned that short positions are being accumulated here, I assumed we'd somehow need to reach this high first. My decision to enter trades or not will only come after price actually sweeps the key liquidity. This brings us back to structure. Don't trade it as your primary factor. Don't base your decisions on it. The market doesn't care about structure, it cares about liquidity. Until you understand this, you will keep getting faked out. Price will violate any structure to hunt liquidity, and those trading based solely on structure will keep getting stopped out. The key is to watch where the liquidity sits. Those are the real levels that matter. Everything else is just noise that the market will use to trap traders. That's why you see these fake breakouts and sudden reversals. It's all about taking out stops before moving in the real direction. Focus on liquidity, not structure, and you will start seeing the market differently. The price indeed moved precisely to take out this liquidity, this range. The market structure is something we analyze after the fact. It can be drawn in any way possible, so we need to focus on liquidity. Now look, if we reach the high of this range, according to this theory, we should also reach the low of this range. Moreover, observe how price moved toward this liquidity. It approached while forming liquidity at the low, then another low. And at the moment when price was hovering here again, probably everyone believed in longs, because after liquidity is taken, price should in theory target the removal of this high. And right at that moment in this zone we had a 4-hour imbalance, which wasn't just an imbalance but also an order block, that I made my decision to enter a trade. Accordingly, in such cases, we always place our stop loss beyond the manipulation that has already occurred. I understand that sometimes price may retest and take out this liquidity again before moving lower, but in this case, I didn't see any liquidity left that would justify a further drop. If there had been slightly more candles here, and accordingly, I made the decision to enter the position, because I like this situation's potential. The first targets that may come into play are this liquidity here, and the main liquidity located at the low of the large weekly bullish candle. And those people who went long here because they saw an uptrend, a structure breakout, they all got wiped out because the market doesn't work that way. Market structure is formed by liquidity, so study liquidity. And if you know where it is, if you trade it correctly, you won't end up being that very liquidity that got trapped many times in this range. And in the end, as you can see here, everyone got taken out on the news. And just so you can be sure that big capital was accumulating chart-based positions here, we can take this small indicator. Actually, it's not entirely correct to do this on Forex chart because the tick volumes here are inaccurate, but at least we can roughly understand that big capital was indeed accumulating its major chart-based positions near the high of this week, the main target. After it wiped out everyone, taking out all participants who set their stops here, it moved toward the low, that is this weekly candle. At any moment when you see a situation like this, they can paint a real high somewhere around here, a real low somewhere around there, and in hindsight it's easy to say, this was real high, this was a real low. You can only determine this in hindsight, if you don't know how to identify highs where liquidity is present. To summarize everything I've talked about today, this theory can guide you on which zones to watch, and after which liquidity zones are swept, you should then consider long or short positions. Again, It all depends on the higher time frame liquidity. Within these ranges, you should only consider entering positions after the major liquidity has been swept. The most important thing is that you grasp this theory. It works very well in the market. However, remember, the lower your time frame, the harder it is to determine direction, because we always assess trend bias based on the higher time frame liquidity. You made it to the finish line. Nice work. As a thank you, I've prepared for you a full PDF file with all these examples and their detailed description absolutely free. You can download it in a pinned comment, and also while you are there, please leave a comment for the algorithm. Smash that like button and subscribe for more trading secrets. Appreciate you watching. Catch you in the next one.